Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
What's up, everybody? Anthony Crudele here, and thank you for tuning in to the Best Moments episode for January 2020. Futures Radio Show is sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes, YouTube, Google Podcasts, Spotify, and Stitcher. If you're enjoying the show, please leave a review on iTunes. This show is also sponsored by Trading Technologies, FTSE Russell, RJO Futures, and Top Step Trader. To learn more about some of the offers that these sponsors have for our listeners, please visit futuresradioshow.com/sponsors. Huge start to the year for Futures Radio Show. We kicked off the year with my annual podcast with Morad Askar, aka Futures Trader 71. Then followed that up with some fantastic traders: Ira Harris, Tommy Thornton, Jim Dalton, Larry Tenerelli, Richard Metzger, and Christian Fromhurst. I pieced together some of my favorite clips from these interviews, so without further ado, let me take you to the best moments for January 2020. I want to talk about something that you and I discuss every single year, is a theme that you're focused on for the upcoming year. What are you focusing on heading into 2020?
So you've kind of hit on it, for convergent trading, for our community and members, and pretty much anybody that follows me on Twitter. The theme for the year is going to be consistent improvement. We want to hammer on that deliberate, focused practice every day. What are you going after today? What are you looking to accomplish today? Because if you don't have that very, very clear in your notes, taped on your screen or whatever, then that's time. Today's another opportunity that's wasted. So there's a that's where that kind of journaling process comes in. How do I know what consistent improvement is if I'm not tracking what my performance has been and what my issues are? If I'm not able to identify what it is that I keep doing wrong, you could talk to a lot of people who are millionaires on a simulator. They go live and it's just, they're just not able to pull a tick out of the market. And it's so now we can identify what has changed between that simulation environment versus live. If they're being disciplined in a simulator, that's where the journaling comes. So the next step then becomes, what is our targeted improvement area, and focus on that. If we can come in and focus on getting rid of our errors, because that's what eats our lunch as traders. It's the demon. We come in and we have FOMO, so we chase a trade. We cancel a trade because somebody of ours on a Skype channel or on Twitter said something against it. We click the wrong button. We've got the wrong size. We're in the wrong expiration. Those are all errors. The more we can eliminate, the better. So consistent improvement, if that is not the centerpiece of what we're doing on a daily basis with a Sunday night review of last week, and then setting out what the new parameters, or maybe a more refined parameter set for the week is. If we don't have consistent improvement, it may take 10 years before it clicks and we're like, this is what I need to do. For me personally, it's the same thing. Your show has been really hammering on the macro side of things with guests like Ira and others. And I feel like, having come similar to you from a scalping background, I'm often missing as much prep as I do, I'm often missing the bigger global macro type of theme. How is this market up here at 3,200, the 3,200 area, let's say in the S&Ps? How is it doing that with impeachment pending, with blah blah blah? There are other forces there that are in play that I just don't understand. So I'm spending a fair amount of time reading through blogs and trying to, doing my best to understand how these things tie together. I feel like the driver, the race car driver that comes in and just laps around the track as fast as possible, which is okay, but I feel like I could be a much better driver if I understood, what's driving, what's pushing, the newer engines, the new aerodynamics, the new composites that go into new tires, their failure points, why we're going in that direction, the rules and how they're changing on my Formula One circuit and things like that. I feel like I can't just show up and just drive, which is how I've always kind of been. I can prepare. Yes, I know the track and I know which turn, and I know what gear I need to be in. I know when to hit the brakes, when to accelerate, and all that stuff. But I more want to come in understanding the business and what drives the business and how things are flowing. So I'm on the same boat as you in terms of taking a bigger and bigger picture view on the market. And in a way, I feel like we kind of, you started trading before me, but I feel like you and I specifically are at almost the same level of maturity in terms of trading. And I feel like as we get older, that bigger picture becomes more and more relevant.
What global macro themes are you focused on right now? And specifically, how they are impacting the markets that you are trading?
Okay. Wow, that's a very good question. Okay. So the year is young, but one of the things that we've talked about is that the markets have been too complacent because of the actions of central banks over the last decade, a little bit more than a decade already, and the impact that they've had on the market. And again, we see it this week. Friday or late Thursday afternoon, when there was news about the assassination of the Iranian general and probably the second most powerful man in Iran, the markets acted just like you would anticipate them to act, and then they calmed down, although the gold and a few other safe haven assets, although not the yen. The yen is kind of sat in here as others, and they reacted because of the uncertainty that this, in the fears that was surrounding people. But equity markets, again, as we sit here, we're back to where, it's almost, I think, 2 o'clock in the afternoon where you're at, 1 o'clock Chicago time. And equity markets are almost back to, I believe that they're higher than they were on December 31st. They are, or roughly sitting there. So they're taking this in stride and not being as worried about it as some of the more risk-off. The metals are hanging in here, but they may be actually the same thing, which is central banks. This will keep central banks lower for longer. So, why not party on? And to me, it's just building up the complacency. And it's like how ranges, as markets become more volatile, ranges grow. Well, these ranges will grow as the world becomes more volatile, because there's certainly, as I like to write about, I didn't do it this year, but in many years past with the blog, talked about potential prairie fires that exist out there. And it takes a single spark to light those prairie fires. So certainly the tinder of a dry prairie is the Mideast, and we saw how a spark could ignite it. Nothing's really unfolded yet, but eyes are upon it. But because of then the belief that money's going to stay loose, they go back and they start purchasing assets because, you know what? Why not? Why not? They're not frightened enough to flee what has been a phenomenal trade. So that's where we sit.
I do want to talk about some of your positions right now and just some of the things that you are currently seeing in the market.
Well, to be quite honest, I'm short indices, and I've been wrong on them. And I use the market indicators. And one of the things that is very important about the market indicators is they don't always work. And people always think it's some like guru type thing that they work all the time. It's really important when they don't work that you understand that it's a trend following and trend exhaustion tool. And when the trend exhaustion does not exhaust up or down, it's telling you that the trend is quite strong. And then you have to perhaps look for another indicator that could recycle. And I know that sounds a bit counterintuitive, but the thing that I'm looking at this market currently as very similar to a couple other markets, maybe the late 1999 move, when the Fed really, put some Y2K stimulus together, maybe more so like the late 2017, January 18 type move. We had several DeMarc indicators that exhausted, and we saw like a little 2% pullback. And we had one, a pullback just recently after an indicator hit, but it just went right back up. And that was a good tell. I want to know when they're failing. And I mean, Paul Tudor Jones has always said, he wants to see when they're failing, maybe more so when they're working. But the thing I'm looking at right now is the overwhelming evidence. And you can look at it very simply. When you have a NASDAQ trading with an RSI at 78 on the weekly, 86 on the weekly, 77 on the daily, it's just super extended. And you don't necessarily want to say, oh, I want to keep going here. I want to keep going here. You want to be out before the music stops. And that's what I did in 2018. I was out, really pushed people out with hedge fund telemetry in the first week of 2018. And then right on the January 24th top, we had another upside exhaustion signal. I bought puts, and that January or the February smash, I think we were down 10% pretty quickly, gave back just a ton of gains. Those puts were just enormous for my whole year.
Hey everybody, a quick pause here to talk about FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Index Futures Contract, symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. Okay, well, let's talk about your overall trading process, and we'll begin with your preparation. Take us through what you're doing each morning to prepare for the day before you begin trading.
Well, it's not in the morning. The first thing I do to prepare for the trading day is at the close of the previous day. As a short-term and mostly day trader, as you end a particular day, your focus is usually very narrow, very tightly narrowed. And as you know from trading for many years, markets get a tone for a particular day. Once that day is over, the tone may be gone. It's easy, for example, on Friday, the market was breaking hard on the close. And if you were just focused on what price was doing right then, very short term, you get very negative. So the first thing I do, the minute the market closes, I go to the bar charts and I go to the monthly bar. So I go from the shortest time frame as I close the day immediately to the longest time frame, which I use as the longest, the monthly bar. I then go from the monthly to the weekly to the daily and then back to the profiles as I prepare for the following session. For example, last Friday, the market was not complete. For example, the all-time high existed in the overnight market. If you observe markets over a long period of time, you will know that it's unusual for an overnight or electronic high to last for very long. That's just simply one data point. The next data point, last Friday's high was not complete. In other words, there was no excess or single prints at the top of the profile. Additionally, when I look at it, volume was below average. So even though you had price selling off quite sharply and selling off near the close, when you go back and look at the charts, you say, wait a minute, the trend is up. And the trend is the most important thing I think that you're going to deal with in the market. So I put my mind back and I said, okay, the trend remains higher. Then I work backwards, and when I get back to the profile, then I start thinking about preparation for individual trades. And that then becomes a question of looking at data points. So one data point would have been the all-time high being made in the overnight market. So that's a data point that says the odds are we could go higher. The second data point was that no excess or completion to Friday's high. That suggested we could go higher. And the third major data point was volume was below average as the market broke on Friday. So I put a tweet out this weekend and I said, all I saw was liquidation on Friday. So as part of my preparation, I'm saying all I saw was liquidation on Friday. I didn't see a more potent combination of liquidation and new money selling. If I'd have seen, higher volume, better tops, I may say, wait a minute, maybe we have change going on. So when I put out a post this weekend, I said, I don't see any indication of any significant change having taken place in the market. And of course, I don't know, I'm not looking at the market right now, but we've been, inside Friday's range. Then when it gets to the morning, which is, when just before the market opens, I look and I see what has happened in overnight activity. Overnight activity we measure from the close of the previous session. So all of the trade overnight was higher. I think for 7 or 8 days in a row, there has been a counter auction or a correction relative to overnight inventory. So overnight inventory gets too long, a counter auction would be some selling to bring that inventory back into balance. And of course, we got some liquidation this morning that brings that inventory back in the balance before the market moves higher. So I'm prepared with that. Next, I say, where are we going to open? And I look and I say, we're going to open today someplace in about the center of Friday's range. When I see an opening in the center of Friday's range, say the odds are that there's no significant change today. More than likely, we're going to see a rotational market, some rotation up, some rotation down, bringing the market into short-term balance. And that's consistent with on January 14th, Tuesday, January 14th, tomorrow, we start to see the earnings season get underway with, people like J.P. Morgan, Citibank, Goldman Sachs, et cetera. So, the market's taking a little breather, and let's see what tomorrow brings, because that could usher in change or increased volatility.
Okay, just a couple of things I want to clarify. First is you only trade the E-Mini S&P, or at least that's your primary market, correct?
That's my primary market because most of my time now is spent on education, and it's the best and most efficient market in order to conduct education.
And going through your preparation, you wait for the close of the day, and then just talk to us about how you are, your process for this. I mean, I understand that you said you're looking at monthly, weekly, daily, and then you're going to market profile. Are you then writing notes down? Are you marking things on your charts? Are you writing notes so the next morning you wake up, you have this stuff in front of you to then get ready to anticipate for the day?
Yes. The contrast, a lot of people think they're doing their preparation by marking important points or references on their charts and graphs. I think that is insufficient. What I like to do is when I do my research, I like to bring it down to paragraph form. And the reason I like to bring it to paragraph form is one of the most important things we deal with in trading is synthesis. And it's too many people trade off of, single references, and it's really much more complicated than that. But the synthesis allows me to bring all the pieces together. For example, when I write up for Friday and I get prepared for Monday, it's okay. Part of the biggest picture is that all trends remain higher. There was no indication of any serious selling, and the market appears to be overextended, in my opinion, but no indication that there's been completion to the current upside auction. So then the synthesis comes out that I don't anticipate any major change taking place on the start of the following week. But I think putting it in paragraph form is far more important than fooling yourself by just marking down references. It used to be when I ran a trading desk, I ran an institutional trading desk. And when I knew a trader was in trouble or with a position, or at least I thought they were in trouble, I would bring them into my office. I'd put a legal pad in front of them. I'd say, write down your thoughts on the trade. And they said, oh, I understand the trade. I said, no, write it down. And what I found, if you can't write down in a paragraph synthesis of what you're really looking at, your clarity on the market isn't anything or even close to the level that you think it is. You start to write it down and you stumble, you better stop and take a second look. So I think it's important to put it in paragraph form, which is my way of making sure that I've addressed synthesis.
You mentioned that you scaled out of one of your positions. I can't remember, have you always been scaling in or out of your positions, or is it something new? And also, what's the reason for you to take a scale off? Is there a technical reason at some point? Is it a dollar amount that you've made or even lost on a position? What triggers a scale?
That's a really good question. And I've got to tell you, Anthony, I just want to compliment you. You ask some really, really good questions, and I appreciate that. So scaling is another part of my evolutionary process. And this is something that started probably 2 years ago. And what I constantly look to do is I'm always looking to refine my process. And what I do is I analyze my trades and I say, okay, what do I feel that I could do better here? Or what do I feel would increase my returns or reduce my volatility? And what I found with traditional trend following is the very old school trend following is you get a signal, you take a position, you ride it, and then when you get a reversal signal, you close out your position. One of the drawbacks that I experienced with that, and it's not that it's a drawback with trend following per se, but an issue that I ran into is I'd wind up having these big winners. And then by the time I would get the reversal signal, I'd wind up giving back 30 or 40% of the move, and that wasn't something that I was happy with. So what I started to do, and I used the same technical indicators. I really don't go into the indicators, but what I started to do is I put together a rule where if I'm in a position and it goes up 20%, then there's a chance that I'll scale 10 to 15% out of that piece, usually it's based on ATR range expansion. So if a stock's trading in a low volatility range, and then like, for example, this happened last summer with Roku. So I got into Roku at 94, and that was on a pullback to the 50-day moving average, and I put the chart up when I did it. So I got into Roku at 94. I think I had a 12% stop, and I started down about $6 or $7. But then Roku started to go straight up. It started to get a little bit parabolic. So what would happen is I scaled out probably 3 or 4 times, I think, along the way, because every time it would make one of these large volume spikes, and the ATR would spike. You know, you never know, is that spike going to be the final spike or does it keep going? So what I found is if I take a little bit off and hit the cash register, but still keep the core position in, what it allows me to do is I never know when the top is going to be, but what it allows me to do is scale some up on the way. It's increased my P&L, but it's also reduced the volatility in the accounts.
Yeah, for me as an intraday futures trader, I have been someone who's been scaling in and out of positions really since the beginning. And one of the things that I really like about scaling, specifically about out of a trade, is a question I get all the time. How do you hold on to winners longer? Well, I could say in my career, holding on to a winner with a full position from beginning to end has maybe happened a handful of times. This is over 20 years in my career. I tend to hold a fraction of that position to the final point that I think it could reach a lot easier on the brain and the body because I've scaled some off. I just feel for me when I scale back on a position that it helps me feel better about holding it. And that's just for me psychologically. Everybody's different. A lot of people just feel just as good about holding a full position as a smaller position. But for me, holding it throughout the day to a target that I think it can go allows me to deal with the volatility a lot better. And I just tend to sit back and watch. I mean, I know that you're trading on a much longer time frame, but do you find that by scaling, it helps you hold these positions longer?
1,000%. I couldn't agree with you more. And because what happens is if it becomes an all or nothing proposition, and I got into some things that became volatile. So I got into Bitcoin. Luckily, I think it was April or May. Whenever it went over 5,000, I took the ETF GBTC, and then it just started to go through the roof. And if I was in an all or nothing where I'm either going to sell all of it or keep all of it, I think I probably would have bailed out on the position much, much, much too soon. And I've got a few stocks that the same way, like Shopify is a core example. If I had to make an all or nothing decision on these positions, I probably get it wrong 100% of the time. And then I'd sell a position and then watch the stock go up another 100 points and ask myself, where did I go wrong? So by scaling, to me, scaling is the best of all worlds, because if you scale a position today, you've got a profit, you take some off the table. If the stock continues to go up, that's great. That's what you want it to do. That's why you're still there. And if for some reason you're lucky enough and you caught it near the top and it starts to head back down, well, at least you've locked in some gains that are higher price. And in either case, it's going to increase your risk-adjusted return. So it's one of the best things that I've implemented, and I've been doing it for about 2 years now, I guess, and it's really helped me out.
Hey, everybody, I want to take a quick pause and talk about RJO Futures. They are a long-standing brokerage firm with personal broker relationships to learn, discuss, and trade the futures markets. To learn more about RJO Futures, please visit rjofutures.com. How were your results as a discretionary trader?
They were not good. I mean, I had, there were various accounts that I had blown through a couple times. There were certain times where I had good runs, but for the most part, I would usually give it back. I was just not built to be a discretionary trader. I mean, most discretionary traders I know, and that I've heard a lot on your podcast, they're disciplined. They're able to kind of control their emotions a lot better. For me, it just was always really difficult. I remember the flash crash very well because I did extremely well on the crash. We were short, I think, about 10 S&P, but I was short about 10 S&P E-Mini contracts. But over the next couple of days, I gave it all back. And so that was kind of the pattern. I really didn't do well. I was not profitable in that discretionary period for me.
So I'm curious, what gave you the confidence that moving over to the quantitative side that you'd be successful there?
Ooh, I love that question. So what did it was I remember one of the first algos I coded was a very simple algorithm. Basically what it did is I was convinced that if you had a big gap up, that the correct trade would be to go short. So this is before I was a quantitative trader. I was a typical day trader that gap up, you go short, put a stop just above where it opened, and then once it fills the gap, you get out. And that's kind of what I thought would work. And I remember writing the code for that, and as soon as it did the first back test, I started realizing, wow, this just does not really back test well. And there's a lot of things that go into this. I mean, it depends on the index, on where your actual entry is, where your actual stop. So I'm not saying that you can't do a gap fill strategy that would work, but for me, I couldn't get it to work. It just didn't, the back tested results were horrible. So finally what I did is I said, you know what, I'm just going to go long and see what happens. And that was my first aha moment, because what I realized is that the hard trade to make on a big gap up is to go long, at least for me. Most day traders are very comfortable going short, but buying into that kind of strength is very difficult. It was for me. When I ran that back test, suddenly I realized, wow, that's it. And that's when I started thinking a little bit differently. Instead of thinking I'm going to force my strategy on the market, I started thinking in terms of I'm going to let the algo and the code do the hard trade, the trade that's really difficult to make as a discretionary trader, and just kind of see what happens. And it's not perfect. I mean, there's no such thing as a perfect system, but in that case, I started feeling like I wasn't fighting against the tide anymore, and I was going kind of with the market as opposed to fighting against it, which I know is cliche, but yeah.
So it was the back testing that gave you the confidence?
Yeah, I would say the back test is what gave me the initial confidence. And as anyone that does quantitative trading knows, back testing has incredible limitations. So, I mean, it gives you, in essence, the most optimistic results someone could probably expect. Although expect is too strong of a word. But on a first pass, yeah, the back test is what gave me the confidence. But what really did it was kind of seeing the trend continue kind of a year later after the back test. So in other words, after the optimization is done and now you're in sort of a blind walk forward mode, seeing those results are really what kind of clinched it. And there's still emotion, involved. I mean, you could have 3 losing trades in a row on that algo where you're going long on a gap up. But what the back test does is it gives you sort of a frame of reference. So if you then lose 3 trades in a row, as soon as you start that strategy, you can at least look at the back test and say, well, was there any other time where we lost 3 in a row? And oh yeah, right there we did. Actually, it happened 10 times, and here we lost 6 in a row. So it just gives you sort of a kind of a ledge to rest on, I guess you could say.
Yeah, I totally get that, because when you go through those drawdowns, it's number one, not a surprise, so you're not changing course. You're not changing a strategy just because you have a drawdown. You're not searching for answers. You're like, look, this is part of it, and we're going to stick with it.
That's exactly right.
So let's talk about the process for developing an algorithmic strategy. Take us to the first thing that you do when you sit down and start developing one of your strategies.
Yeah. So the first thing I do is I will usually begin with just some basic idea. For example, we can use that gap up idea that we were using. So that would start with someone that has been staring at charts for a few years, and you start just noticing, what happens when you have a gap up? And so you might just start with some very basic code that would say, if the open of the current candle is greater than 1% of the previous candle, then go long, else do nothing. And that's a very basic idea of how you start. But you start by just writing some very basic code. But I should probably go back a little bit, though, because you also have to determine, well, what is this going to trade on? So for me, I focus on the indexes, the S&P primarily. And there's reasons behind that I won't go into, but basically because it has the liquidity to support the program that we run. But you also have to pick the time frame. So is it going to be on a daily candle, monthly, weekly, hourly, minute? But once you narrow into that a little bit, then you actually write the code, and then you, in essence, apply the code onto the chart, and you'll get an initial kind of flavor of what that algorithm might be able to do. And usually, someone will also add a stop, maybe a target of some kind. But once you have those kind of three things defined, in other words, your entry, your exit, and then any stop that you might have, then you just run a basic back test. You don't, and I won't optimize them, and you'll just look at the raw results of what that does. And from there, then it can spawn multiple different paths that you might go down. But that's the very basic way that I would start.
And then what do you do from there?
Yeah, so from there, it really depends. If the equity curve is just horrible, straight down, then one thing I might do is just flip it and say, okay, well, instead of going long, what happens if you go short? And then you run that. And eventually, let's say you get to a point where you have some kind of an equity curve that's trending upward for the most part. That's when I'll start looking at it a little bit more carefully to see, okay, maybe there's something here. The other thing I should say, though, is I will, you always want to back test as far back as you can go. If someone only goes back to like 08 or 09, 2010, then I'd be very skeptical of that algorithm. You always want to back test as far back as you can go through bull markets, bear markets, and everything in between. So let's say you're back testing to, 2001, and you've got an equity curve that is sort of trending higher, but maybe still looks a little scary. That's usually when I'll go to the next step and I'll say, okay, there might be something here. So let me experiment with how big of a gap up do I want to go long with? And in this case, let's say we started with the short. The short was ugly. Then we switch it to long. The long, and going long, it's kind of going higher for the most part, the equity curve that is. Then I might say, okay, what happens if instead of a 1% gap, you do a 0.5% gap or 2% gap, or, and you start playing with those to see how it impacts the equity curve. But you always want to be very careful, because the biggest mistake a quantitative trader will make is curve fit. They'll basically look for something so specific that really all they're doing is doing a curve fit. And the reality is that algorithm probably won't do well when it goes live. So, but that'll start the sequence of, okay, so you might write in the code then, or as an input into that algorithm, how big of a gap up you want to enter in on, so that you can then start optimizing. So you might have an input that would say, size of gap. And then what you can do is you can optimize it, you can shmoo, and it can look at a 0% gap, 0.1%, 0.2, and you can start optimizing to see where it makes sense to actually do that entry. And that's kind of the optimization process, which is really the next step, I guess, is you start optimizing it.
A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Now they have integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. You could try it now for free at tryttnow.com. It sounds really like your overall strategy is very discretionary to you. I'm sure you have a process, a checklist, let's call it, of things you look at, but you would consider yourself discretionary.
Right, that's correct.
Okay, so discretionary, and you have, it sounds to me like you just have this rhythm of finding groups and these sectors that you're talking about. Are you using any automation for that, or is it just by you just spending a lot of chart time looking at things?
It's a little bit of both, and you mentioned futures trading and looking at the S&P. I mean, that's basically where I'll start with. One of the things that I do, either on the weekend or definitely one night during the week, is I'll just kind of look at the overall environment. We'll look at things like I mentioned, the advanced decline line. I want to make sure that if I have that, where I'm that process where I'm looking at individual names and sectors and so forth, I also want to look to see what the overall market is doing. I want to look to, and that's the starting place for me, looking at either the S&P, Qs, and just kind of see what's going on in the major indices and if they're clearing resistance, if they're bogged down in a range, or if it's breaking support, right? So that's kind of the starting point for me. And then if I think the environment is strong, if I think the environment is good, then I'm going into, the sectors and the individual names. And the automation part comes with, just basically what I do is it's a very methodical process. I'll go through and just put a lot of alerts at where I think are kind of key pivot points. And I'll basically, rather than, which kind of helps me in a sense to not overtrade as much, where I'm just basically waiting until something triggers. And if I know the alert has gone off and the market environment is right, it kind of helps me get into the trade.
Is this how you've always traded, or has your process changed over the years?
Oh, it's definitely changed. I mean, I'm always, tweaking things a little bit. And, that's the beauty of trading and investing, is that you never get to a point where you're like, I solved it. It's one of those things that you continuously work on and try to get better at, because from experience, and I'm sure you know this too, you just never get to that point where you're like, oh yeah, this is easy. I figured this out.
No, you don't. Talk to us about some of the indicators that you're using on your charts.
Yeah, sure. So there's one that so I love to kind of get into the nitty gritty. I'm not a programmer. I can't write lines of code. But one of the things that I used to do in my institutional career was I knew what I wanted, and going to the programmers and basically programming algos, fine tuning them and so forth. So I've worked with an individual over the last couple of years, and he started with an indicator, and it's got his name in it. It's called Market Webs. What it basically does is use the volume profile, and it will, go ahead and look at like the last period, and then it will draw like a nice range, what we call the value area, and it will basically kind of give you a heads up if something is trading just, what we say in value or in a range versus breaking out. So you could use, the beauty of this is it doesn't matter what kind of time frame trader you are. You could be a long-term trader, and you could use this on the weekly chart, and you'll have a value area for the whole year. If you're using the daily chart, you've got a value area for the month. And then, I'll also use the 1 hour chart too, and you'll have a value area for the week. So this really helps with just basically spotting breakouts. And if something is trading in a range, I really don't have a need to really trade it unless it's basically just, starting to kind of move from a downtrend to an uptrend, or, kind of recover a little bit from a dip. But for the most part, what I'm looking at is for names to kind of move out of a consolidation area, and I'll do that. And on the 1 hour chart as well as the daily chart for the most part. And when they line up together, then I've really got to trade.
Actually, I have to say that I'm surprised hearing you say that you use a volume profile as a stock and, ETF trader. I can't say that I've heard too many people before that trade stocks talk about using profiles. How long have you been doing that?
Yeah, this has been going on now for a couple of years, and we've been refining an indicator as we go along, as we find more significance with doing it. But, to me, it hits home with, what I used to do as an institutional trader. We just always used to know that certain traders would care at different levels. And that kind of, now how I'm trading now, we'll see that certain levels will come into play, again, and they'll almost act as like gaps sometimes. So it's remarkable, sometimes volume, and again, this will really look at volume, price, and time, and kind of meshes those three together. And we'll just find that there will be a certain level, as a name is either breaking out or is getting back to levels from where it was years ago. It will just have a memory to it, which is pretty, it's fascinating. But, we'll look at a particular level and we'll say, hey, this is a level that I will, take profits at. which again just really helps in trading once you kind of map your trade out before entry. And we'll see it again and again where there'll be significance at a particular level that was from years ago.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.